In this video, we cover accounts receivable and uncollectibles, or in other words, bad debts. Sometimes customers just don't pay what they owe. Here's a typical balance sheet, and we will be focusing inside the current assets section, which contains accounts receivable, reduced by an estimate for uncollectibles, or bad debts. Here is a real-world balance sheet, prepared by Caterpillar Financial Services for 2016. Caterpillar is the world's leading manufacturer of construction and mining equipment, diesel and natural gas engines, industrial gas turbines, and diesel-electric locomotives. Like all balance sheets, total assets equal total liabilities plus shareholders, or in this case, stockholders' equity. Caterpillar is actually two entities, a manufacturer and financial services. We will focus on the financial services entity because it is in this area where Caterpillar manages its receivables, called finance receivables on the balance sheet. These receivables, which total over $26 billion for 2016, are primarily comprised of receivables created when Caterpillar sells its products to customers and then provides customer financing. They comprise 78% of the total assets of Caterpillar Financial Services, and about 1/4 of the total asset amount when adding together the assets of both Caterpillar Financial Services and Caterpillar Manufacturing. These receivables are disclosed net, which means that they have been reduced by an estimate of bad debts. And Note 3, which we examine later in the video, will tell us more about those bad debts. To understand accounts receivable, we must first understand the principles of revenue recognition, or when should revenue be recognized on the income statement. The basic answer to this question under both US GAAP and IFRS is when the service is performed or the product is delivered. At a fundamental level, when you have done your job. That's when you are supposed to book revenue on the income statement. Sometimes cash is received before the job is done, and in that case, we book a liability called unearned revenue, which is converted to a revenue when the job is completed. Sometimes cash is received at the same time the job is done, like at a grocery store, and in that case, cash and revenue are booked at the same time. And finally, sometimes, in fact quite often, cash is received after the product is delivered or the service is complete, and in these cases, an accounts receivable is created and it remains on the balance sheet until it is removed, usually when the cash is ultimately collected from the customer. So in summary, an accounts receivable is created when cash is received after the service is completed or product is delivered, or stated another way, revenue is recognized before cash is received. The receivable increases assets on the balance sheet, and the revenue increases net income on the income statement, which is closed to and increases retained earnings. For what kind of companies are accounts receivable important? Managing receivables is very important to financial institutions like American Express and Bank One because their business is making loans to customers. Receivables are also important to large manufacturing companies that own their own financial subsidiaries like Ford, Caterpillar, which we described earlier, and General Electric. These companies are actually part manufacturer and part financial institution. Telecommunications companies like AT&T, Verizon, and Comcast have to pay close attention to their considerable receivables because they provide services to and then build a wide variety of people from all walks of life. Managing these receivables is an important part of their business. And finally, retail stores that offer their own credit cards, like Dick's Sporting Goods, have to keep close track of customer credit. Interestingly, in recent years, many retail stores have moved away from offering their own credit cards, selling the activity to financial institutions that specialize in managing receivables. The major problem involved in carrying receivables on the balance sheet is simple. Sometimes customers do not pay. Some of the receivables on the balance sheet will never ever be converted to cash. Interestingly, The next screen on the video you just watched reports that Caterpillar expects to lose $343 million in uncollectible accounts receivable as of the end of 2016. Wow. How do they manage that loss? How does that loss affect their financial statements, their balance sheet, their income statement? This course, which consists of 5 videos and a little bit under 2 hours, covers primarily the area on the balance sheet called current assets. And the primary current asset are receivables, inventory, and some investments. The well-known firms that are covered in this particular course include Caterpillar Financial and their receivables, Caterpillar Manufacturing and their inventories, as well as Nordstrom, a high-end retailer, as well as Yahoo, another internet company, Barnes & Noble, a bookstore is having some trouble, and Amazon.